Good morning, everybody. Welcome to the Flow Show. Hope you're all doing well. Hope you had a good day yesterday. Not too much to worry about over the BOE and stuff. Hope you made plenty of pips. Morning, Kay. How you doing, mate?
Hi, D. Hi. How are you?
Good,
I'm all right, mate. I'm all right. Took one side of the market, missed the other, but such is life. Better to miss one than to take it up the lederhosen.
Yeah, exactly. We can all we'd all retire on the ones we miss, mate.
Oh yeah. As I was saying this morning, because we had a whole discussion, as you know, in the room about missing or stuff, putting orders to close and things. I said if I would hang myself for every missed opportunity, there would be no rope left on this planet. That's a fact.
Yeah, exactly. Yeah, that was a good conversation because people, people get the hump when they lose money, and people can get the hump when they don't make money. But in that situation, sometimes you get unlucky. You have a stop that's just a bit too close, and a couple of pips would have saved you. But it's always, you can beat yourself up. It's always important to also consider in those situations, whether you got the execution wrong, you at least got the trade right. So don't take the positives when they're there if you can. And there's enough to beat ourselves up about without things like that. So yeah.
And the real good thing about our community is we can talk about everything.
Yeah. There's always someone to pick you up.
Something, just write it down there. There will always be someone to either put an arm around the shoulder or give some well-meant friendly advice.
Yeah. And we're not averse to telling you when you've been stupid either, and that goes for all of us. I'm happy to be told when I've done something stupid. Sometimes it's just the wake-up call you need. So that's a great thing about our community in the chat room. It's honesty. There's lots of honesty there. No one hides behind anything. No one's embarrassed. I certainly don't get embarrassed. Pride does not come into trading. If you've got pride in trading, you need to get rid of it. If I make a stupid error, you'll hear about it, and then we'll all laugh about it as well. So self-reflection is always good, but a community is better. Right, let's get stuck into it. I probably need a bit of help from the BOE from Kay because I was out for it, but we'll get over all the headlines anyway. Right, starting with Japan, SocGen have changed their BOJ call. They now see BOJ raising policy to 0% and abolishing their yield curve control in March. So now we're still got March on the calendar for a lot of central banks going on. There is a potential incoming problem for the government at least, which is not unknown, but it's now being put into words and numbers by the government. Their interest rate costs, according to their own draft documents, are seen more than doubling over the next decade. Obviously, a natural reaction to rates going up. If they go up in Japan, they're going to be paying a lot more, and they obviously have a lot more debt, which is one of the big reasons why Kishida wants these big wage rises. It's not just the fact of digging them out the deflationary hole they've been in for so long, but it's also an income stream. Higher wages, higher taxes. It's almost like a very loose, wonky arbitrage trade where if they're going to be paying higher interest rates on their debts, they need to get that income to pay for it. It's not down to the BOJ, it's down to the government. So that's why they want the economy picking up, wages higher, because it goes into their coffers. So that's all to come. Okay, that's going to be fun and games on those interest payments, isn't it?
Yeah, that's one thing, but don't forget there's always something in Kishida's mind, and that his LDP is under fire right now, and there's elections coming up in not too far a distance either, which he can decide upon actually when to hold them. But I don't think he will hold them too soon, because now he needs to put out fires within his own party. But yeah, of course. I mean, if you pay the people more, they will be okay to borrow more, and they will be okay to pay more taxes, and but I mean, then something has to change because I hope it drives the younger generation out of mom and dad's door to start really spending instead of saving it all. Because if it's all to go into the savings pot, then it's not really going to help too much the economy.
No,
Because in
no,
Japan, we have to know that demographics, cost of living um, have made so that the younger generation is less and less getting married, making less and less babies, and demographics are not really good. So they're trying to break this, but this downward spiral. But it's gonna take some work. But in any case, if it works. For the short term, if it works for the economy, it's all a bonus, of course, right now.
yeah, and that's one thing we have to remember, and we've said it right from the start of all this. And often when talking about Japan, it's as much a mentality change for the whole country as it is trying to change the economy. You know, there's a huge mentality difference. They've been in such a deflationary and all this pressure and difficulty for so long. You've got to change around that mindset. You know, we've got strikes over here and everywhere for people asking for more wages, but in Japan, it's fighting tooth and nail to get those wages a bit higher. So yeah, it's changing around the mindset, get people spending, not saving. That's what Kishida's virtuous growth cycle is all about. Question then: if they get these big wage rises in the spring, could that trigger Kishida calling an election? You know, trying to ride that positive wave. Or hey, everyone's a bit richer now. We're doing all right. Do you think that might spark talk of an election or get him thinking about it?
If he manages to clean up the house in between, it could. But that is it's a good question, but a very difficult one to answer.
Yeah,
Because will he want to go straight away into election, or will he want to and somewhere take a little bit of a risk? Will he want the economy to show up what the impact is of those higher wages? In which case, he's not going to call earlies, right?
yeah,
It's an interesting question because I should ask a couple of my Japanese mates what they think about it. It is an interesting question. I would say he may be tempted to wait to let this political internal storm go by, and then in the meantime hope for the economy to tick up, and
yeah,
just to show the people, you know, because the Japanese are they are usually how shall I say, relatively loyal to the LDP, where it was DPJ before. But if they change massively, then the LDP is probably going to take them 15 years to get back. And that's what's happened in Japan with the DPJ in the past. So I think he may have at least tried to learn from prior mistakes and let the economy get better first before calling the election.
yeah. I think they might be right. Give it a few months if he gets his wage hikes, get some good data under the belt, and then go for it.
Yeah.
Perhaps maybe look in Q3, beginning of Q4, something like that. At a guess, but yeah, one to keep an eye on. We need lots of eyes in this game. Right, over to His Majesty at the Bank of England, kept rates unchanged as expected. The vote split went 6 for hikes, 6 for unchanged, 2 for hikes, and as expected in a lot of scenarios, Dingra voted for a cut. As I was musing yesterday in the chat room, the 6-2-1 is largely no real shock. Dingra going to cuts, the other two staying for hikes, and the rest unchanged. It keeps the message largely unchanged. So it was Haskell and Mann who voted to raise rates, as they have been doing for quite some time now. Some of it was pretty much a carbon copy of all the other central bank meetings. The BOE dropped their reference to the risk of further tightening, a bit like the Fed did. Said more evidence is needed before we can lower rates, exactly as the Fed did. I thought this was a bit strange in the forecasts. They see CPI returning to target in Q2 2024 versus Q4 2025.
No. I don't think so. If you're reading that, it's a misprint there. The returning to target? No, not in 2024.
Yeah, but it's returning to target and then rising above 2% in Q3 2024. They've gone for a wave pattern on these forecasts. And now they don't see it back at target until Q4 2026. So that they're trying to build in some of this short-term inflation problem that the ECB have spoken about and whatever. If I've got my numbers right, which I had a look at the forecasts just this morning. So they're seeing it come down sharply according to the forecast, and then going up again, and then coming down slowly again, which is a bit of a, as I say, a bit of a wave action. I found it strange that they've gone a bit noisy like that. They don't tend to be as volatile, those numbers. But anyway, that's what they reckon, down towards target in Q2 and up, then back above it in Q3, and then not back to target until Q4 2026. Either way, they now see the bank rate coming down a bit too, down to 4 point, and this is based on market levels for rates, 4.2 in Q4 2024, 3.4% in Q4 or by the end of Q4 2025, and 3.2 by the end of 2026. So those rate expectations coming down, but still, as you can see, pretty high, 4%, 3%. So that that's the higher for longer message they're trying to instigate in that. Now, BOE's Bailey in the presser after said it's good news on inflation in the past few months. Things are moving in the right direction. We have come a long way, but we are not there yet. Not yet at the point where we can lower rates. The level of the bank rate remains appropriate. CPI may tick up in January due to base effects. And on the subject of rate cuts and the like, says it's not as simple as inflation returns to target in the spring and the job is done. Continuation of trade disruptions are the upside risk to the inflation projection. The economy is set to pick up with a bit more speed. He said they will not speculate on what we will do at the next meeting, but we will not maintain the policy stance for longer than we need to. We don't need to see inflation back at target to cut rates. We need evidence that it is heading there. So again, a similar view to what we've heard from the Fed and others. He was then out on doing the press rounds, talking to Bloomberg TV, said that the view the markets are taking is not one I object to. So the market's still a bit more dovish than the Bank of England, but Bailey's saying that he doesn't really mind that. That's having an effect of untightening financial conditions without them having to do anything. Yes, mate.
Yeah, that one was pretty funny because during the presser, he said that he found what the market was pricing as conditions was a bit too loose right now. So he basically said the opposite of what he said during his press conference.
He's saying he's all over the shop again.
Yeah,
Are you saying he's all over the shop again?
Yeah, he was a bit yesterday, but he was quite, as we call it now, undovish. Well, Sterling tried to make up its mind. We'll have a look at it, and perhaps I'll talk a bit more about it in detail. But he was undovish, let's put it that way. But during the press conference, he clearly said that, okay, a bit further out, the market was a bit too loose compared to their own forecast. So, but then on Bloomberg, he said the opposite, right? He said the markets are relatively pricing it as he would price it.
Yeah, pretty much so. So anything else you picked out from him that he said of note, or it all looked pretty much as expected? We're not ready to cut. Things are going A-OK. We're not in a rush to cut, but we're not ready to, or we're not really looking to hike again.
Yeah, that's what I said on the in the chat room as well when he was babbling. He basically did a bit of the undovish stuff, and then probably picked up the paper that ECB and the Fed had written by Chat GPT, and then he read that one out again. So they're all basically on the same wavelength. But I'd say he wasn't. He was much less hammering on risks to the downside than he may have been at some stage last year. Because as we know, I mean, it was a running joke that before, when perhaps like August or September or so last year, that whenever Bailey opened his mouth, the sterling was going down. Well, he was not that destructive yesterday. So yeah, I think in a way it underpinned the sterling. It's of course not. We've seen a big dollar move as well develop afterwards, but sterling did keep a relatively supportive tone while he was talking. So I would say nothing really dovish in there, which would or could have been a risk, as I said yesterday morning. The risk is that he turns dovish, but then already the vote was, as we said, Digra was likely going to be voting already for a cut because she's an Uberdove. But I think the two keeping for the hike. That's why we were talking about the 711 in the room. I think the 621 was also quite undovish.
Yeah, as expected. And where do we leave us in the quid? It leaves us still in the bloody range. 126, 128. No change there. So come out the BOE. Where are we? Where we were before. In that range. Move on. Look for something to happen. What I would say, though, is the longer a range goes on, the greater the chance are that when you do break, you're going to see a big move happening. Because this becomes like a coiled spring in effect. So we've been going on for a couple of months now. Probably the longest cable has had such a tight range, I would think, for quite a while without looking all the way back. We can go back at least into 2023. We can see this is quite a long consolidation period there. So when it goes, it's probably going to go bigly. But you want to see it break out of these extensions as well to see that. But anyway, if you trade in the range, happy days, but just be mindful of if it does go. Over in Germany, the Industry Association VDMA says the decline in German engineering orders has eased in December. So maybe a bit of light relief coming there for manufacturing and the like in Germany. Over in the US, we had some data yesterday. Fairly big data. Challenger layoffs, 82k, a big jump up there. I haven't looked at the report. I don't know if you caught the report yesterday, Kay, as to what sectors, what firms were coming out in there, but that's quite a jump, 82,000.
No, I haven't looked at. I did not look at the details, but we've been talking about layoffs and cuts and job cuts, and I guess that's a reflection of it.
Yeah.
There's a bit of restructuring also going on, but no, I think there was a detail, but I think it's just because we've seen it across sectors the job cuts. It's not just one sector, and I guess it's just a reflection of that. It's still down on the year on year, so there may be some sort of seasonality perhaps in there, but it's still down on the year on year. But yeah, we've seen people announce it. Another hint, or not, for today's number, but so far all the prior numbers for job job announcement or job numbers have not been too representative of what's happening on the NFPs.
Yeah, very much so. I've just called up the report while we're talking here. Financials and tech seem to be the biggest cutters.
Well, that's what they announced, right? City.
Which is
And
which is exactly what we've been following
yeah,
in the news and whatnot. But yeah, a big jump. Again, it doesn't mean the jobs market is in imminent danger of collapsing, but you know we've been seeing this trend now for a few weeks. If it continues growing, the numbers are going to start adding up, and then we will see an impact coming into the main jobs numbers. But until then, everything's trucking along as normal. Jobless claims, no red flags there. A little bit of a tick up in continued claims. We'll keep an eye on that one. If it starts busting above 2 million, that's sort of the level where things might start getting a bit spiky for the jobs if that number goes up. But initial jobless claims still in that 200k mark, low 200k mark. Nothing to worry about there. Unit labour costs. Another one just to keep half an eye on for the Fed, coming in a bit softer, much like we saw those ECI numbers yesterday or the day before. So a little bit of wage pressure coming off in the US. Again, big number today is going to be the wages data. The year-on-year number, we'll look at that in a moment when we go through the NFP stuff. S&P, the final number for manufacturing over there came in a touch better, 50.7, better than the flash 50.3, and went up over last month. ISM manufacturing also looking okay, an improvement, still in contraction, but it moved up to 49.1, much better than the 47.2 expected in last month. A big jump in prices paid as well, that inflation component going into expansion once again. So that was all in contraction and, helping the Fed out. Now we've seen a bit of a jump up there. We'll see how that's reflected in the other sectors. New orders, decent improvement there. Employment, though, a little bit softer. So that's, again, another trend that we're seeing at the moment in the jobs numbers. But overall, fairly positive data I'll take from the ISM there. Any thoughts on that data, Kay?
got shrugged off. Dollar moved 15 pips or less. Euro dollar went from 20 down to 5 and then straight away back to where we were. There were apparently much bigger fish to fry yesterday. It all booted off really once. Already in the fixing, the dollar was starting to come off a little bit. Then there was the banking coming down. Yields were coming down despite the that's what I was going to say. When those numbers came up, yields went up like what 2-3 BPs and lost it straight away. And no, there was a much bigger fish to fry yesterday.
Yeah, the market seems to be getting antsy over this regional bank stuff again. From what I can read, I don't know if it's a bit of a storm in a teacup, rather than anything, going back to the SVB days or anything like that. But who knows? The market likes to make a fuss of certain things. But we'll see how that develops. But that New York banking court was down again yesterday, wasn't it?
Yeah, and there was another one as well. I just forgot the name about it. There was another one as well, but the whole thing. There's been articles out about peak, like usual, right? When people are coming out with their earnings, peak performance. They will not reach that again, and then, but once more, and that is something that for us retail traders or people sitting outside dealing rooms or in those markets have sometimes it's difficult to know exactly what's going on, but it seems huge rebalancing as well from one into the other sectors. It's still ongoing, if you look at S&P, then afterwards, of course, helped by other stuff, but I think there's still some rebalancing going on. let's say I hope it's a storm in a teacup. I was also advocating for the fact that it may be because Fed is keeping the discount window wide open. So for them, if they need stuff, so
Yeah.
yeah, I mean, yeah,
The safety nets are still there.
sorry.
The safety nets are still there.
Yeah, there's some safety that's still there, but I do also know, I do also understand, and in a way you can find it back in the Chinese equity markets as well. If the market doesn't want to hold something, it can't go up,
Yeah.
and that's money moves around, right? And I think we are still struggling with or them are still struggling with the fact that the market doesn't want to hold that, and then you see, of course, moves like it, because there's always people like diversified portfolios, and they say like, okay, we have to go down from just as an example, 5% to 4% in holdings because we want to be underweight. Well, 1%, 1% can, if they all portfolio managers go 1% less invested in a sector, the sector is going to lose.
Yeah. Yeah. It's a lot of money when those 1% all add up. Exactly.
Absolutely.
Yeah. Right, moving on quickly to Canada. Their manufacturing PMI had an improvement as well. And then we had Macklem out later. He was reiterating that if developments push inflation higher, we may still need to raise rates. So doing his walking the fine line and chucking bits either side, depending on how the data is turning out. While we're on jobs, Zoom, they cut 150 jobs this week. Again, not a lot, more of the trend. So we've, I don't know how much more I'm going to keep noting all this stuff unless we start getting some big numbers. We know what's happening. So I'll keep my usual thumb on the pulse and we'll keep an eye on that. Just one for your calendars this weekend if you're bored and if you can get access to it. Powell is going to be appearing on 60 Minutes on Sunday, I believe, where he will discuss interest rates and inflation. Whether it's going to be anything more than what we've just had at the FOMC, one has to wonder. But it might be an opportunity for Powell to correct any price moves that he's seen since the FOMC that he might want to correct. Not that there's too much that he probably needs to do. We haven't broken anywhere significantly in any pairs or assets. But if he wants to give a secondary message, that may be where he wants to do it. So it's a bit of weekend risk on that side of things. So just keep an eye on that one. Also, a bit of weekend risk is this bubbling stuff going on in the Middle East, the US, threatening to step up retaliation, go a bit more. So that is something to watch the weekends, particularly if you're trading commodities and risk trades in general. We may get a bit of risk aversion or a bit of closing of positions, taking some chips off the table, taking risk off the table into this weekend. So be prepared for that later in the day, particularly after we're done and dusted with the NFP and whatnot. Right, so over to the NFP. We'll have a quick look at that. Go through the usual rules. We're expecting 187K. So most are looking around that number, 180, 190, that sort of figure. Anything like that will be fine and dandy. Again, we're looking for a big variation. The big price move will come if we ever get a shocking number. But conversely, if we get a decent number, let's say we get another bull buster, something like a 300K plus or something, look for the dollar to gain, look for yield to gain, but look for that rally to get hit, as we've seen time and time and time again. So again, I think today is going to be a case of plotting your levels on the range edges, seeing if you get a test of them, and then making a decision whether you want to trade them or not. As usual, the way to read the numbers, headline first. If it's in and around expectations, move on from that pretty quickly. Look at the unemployment rate, expected to tick up a pip to 3.8%. look at that number, then quickly look at the participation rate. Has that gone up or down? Because that has a big input in that unemployment number. So if that goes up to 3.8%, and the participation rate has gone up as well, that could be the reason why that has jumped. If it goes, even a bit higher, if that goes up while that comes down, that's bit of a different situation. The perfect storm for good numbers is unemployment down, participation rate up, and vice versa for bad numbers. And then keep an eye on this wage number, which has been really sticky around this 4%. I think it was last month it was expected to go to 3.9 from 4%. It actually went up to 4.1%, if memory serves me correctly. So the Fed are watching wages just as much as maybe the ECB. It's a big component there. So even though they're seeing their ECI numbers and all that Q4 numbers going the right way, this is still staying a bit sticky. So keep an eye on that one as well. Don't forget, I should add, that we have our NFP competition up and running, and which I will put the link up there shortly if I can find it. There we go. Boom, boom, and where's me thing? Boom. So there's the link there on Twitter for the NFP competition. If you haven't entered, place your guess on that tweet and on that tweet only, and we're giving away, as usual, 3 lucky winners will win a free month on our platform. So get stuck into that one. You won't win because I've picked the number 10K. I'm going for. That's going to be the number. What?
10K.
10K.
All right. Okay.
I like to be different.
Yeah. I've gone with my usual 111. So let's see. What do I win if I guess the right one?
What do you win? You win free entry to next month's competition. you can win a lifetime of free entries to the NFP competition. There you go, mate. How generous am I? Right. So that's what you got. Any expectations for this one, mate?
Well, I've got a question actually, more than an expectation. What was that thing about redoing those calculations and stuff? Is there a new method? Do we need to expect something dramatic to change in those numbers? Because I didn't quite get exactly what they are meaning to change. That's the first thing. The second one, look for the revisions on the NFPs. The revisions have been continuously worse over the past months. So I think that's somewhere where the market reacted upon as well last time. So watch for those revisions as well, because the revision number may influence the market. But first of all, yes, that question about those different methods.
Well, I hope you're not asking me, because I was hoping you'd lot would give me the answer to that.
I've got a clue,
yeah, there are some new measures and calculations going on. I personally didn't really understand them all. They do like to make things pretty complex. Let me put it up for you guys and girls just so you can see
There's
that.
some actualization or stuff also but I really most of it I don't understand how it's going to affect it. That's the thing.
Yeah, so I think we get see new population controls, and so this is to do with population, but it won't be revised to incorporate the new controls. Yeah, so they're saying basically the 2024, this data today will not be directly comparable with data for December 2023 or earlier, but they will show a table showing the effects of that. And also their hours and earnings data will be revised to reflect the annual benchmark process and blah, 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 blah. Anyone who knows what's going on, let us know, please, because we haven't got a clue. But there could just be some fun and games within.
Exactly. I mean, exactly. What about getting completely distorted numbers and not knowing what they mean?
It's possible. And my answer to that is trade the bloody ranges. And that's it.
Close your eyes.
Close your eyes, trade the ranges. If the ranges hold, you know what to do. But anyway, That's what makes it fun. They like to confuse us. I mean, at least they seem to be sorting their crap out, unlike the UK ONS. They're still in a mess with their jobs numbers. Bloody useless lot. Anyway, to finish off the afternoon, we're going to get... yeah, if anyone's still about for that.
Thanks, Gav.
We're going to get... we're going to... oh, yeah. Drink from Ryan. Oof, don't know about that. It's, by all accounts, Kay's son is drinking the drinks I got him most recently, playing through the old Black Cow vodka. Anyway, factory orders, durable goods revisions, and then we get the Michigan numbers, the flash numbers for January. I think they're the flash numbers. I can't remember. This month's gone so quickly.
I think it's second also. Is it not?
Is it the finals?
I don't know whether it's finals or so. I never know whether they have like second or third.
No, it's the finals. It's the finals.
Yeah, because I think we had them already. Yeah.
Yeah. So just keep an eye on those inflation numbers if there's a big variation to the changes there, because that's the thing that they like to look at. Well,
you know what? And I'm basically agreeing with what you said a bit earlier on the dollar today. Was a big move yesterday and a big reversal, and I don't think it was just a bit of managing positions. There's been those announcements, those releases of the of those results, the buybacks, Meta and stuff. It seems that the market was rather waiting for that. So I think if you see, I've updated my thoughts in the room as well this morning, and clearly my, let's say, bias or original thought is that well, I always trade two things. I trade either I trade the dollar on US data, but then I also trade risk on US data, and it does seem to me that whatever the number is going to be, and unless you get 3.5% unemployment, then a 450K number and stuff like that. But I don't see a lasting recovery of the dollar today. I think a lot of people have missed this move, have been a bit wrong-footed, and we can see it from the PA as well. Otherwise, people would actually undo a little bit of the moves that we saw yesterday, but we had a continuation. So for me, that means that people have relatively missed those moves, whether it be on the dollar or even on risk, because we see the yen pairs when nobody wanted them yesterday. Now you can't find any offers, and same thing on the commodity currencies, which were seemingly ready to drop out of bed yesterday. Now they're very, very big. So I think that testifies of a market that hasn't really got the position. Yeah, and it's looking at the euro. Something I said yesterday about the euro. You know, we are in this downtrend. It's still going, but every time we make a low, there is quite a significant bounce after. You can see that every single time. Boom, down, up. So it's good for range wise, because it's giving plenty of pips in the middle, right? Rather than doing a one of these slow bleed type moves here. But it's like we say, you can't get married to a trade. If you get in a position, if you make decent money, I know, you know, one of our guys, DK, looks at the ranges, the average trading ranges and that sort of thing. If you get a move that's a decent amount of pips, you've got to take some money off the table for, you know, trying to conserve your money against seeing a reversal, because it's, you know, we're getting some big zigzags going on in here and a lot of pairs. And I think today the NFP is going to be the same, unless there's, you know, an absolute gangbusters beat or an absolute shocker of a loss. And I still think there might be a little bit of risk of some weather-related shenanigans in this number. We've seen it before historically. I think 2015 was, if I recall, we got a minus 80K or minus 100K or something, which was a complete surprise, and it caught all the market on the hop, and we saw a strong reaction. And then it all recovered when everyone said it's the weather. So this month can be a bit of a funky month historically. But as I've been saying all week, you know, doesn't matter what it does during the week. When you've got all these big events, where it finishes the week that's important.
And euro dollar, it hasn't gone anywhere new so far, and the same for a lot of pairs. Dollar yen, yes, we're under this 147. It's looking like that might be a bit of a significant range break, but that might just put us in another range, 147s, 145, something like that. But it still is pretty tight. We're still talking 200-300 pips over the last couple of weeks. So not doing an awful lot. And pound, as I mentioned as well, cable stuck in that range. Come through Fed, come through the BOE, come through the data, come through everything, and we're stuck. Aussie dollar, another one, looked like it was breaking down yesterday, maybe getting a proper test of this 6,500, this fib down here. I'll come back tonight, sitting on the train looking at the prices, and we're back right bang in the middle of the range and tapping on the 66 handle again. So yeah, it's hard to get a bias in this at the moment, Kay, and pick a trend, isn't it? You've just got to, you've almost got to throw your bias out the window, throw your I think out the window, and just trade the prices.
No, that's absolutely it. You really should respect levels even more, but I'd argue that majors against the majors, that the dollar is sold a bit more eagerly than bought. I mean, yeah, I mean, of course, you have to respect those levels and stuff, but where January was about, and we've been talking about, and Mark was especially noting that in the room as well, saying that when the States come in, they're buying dollars, whatever, and that thing has changed this week into month end and into the start of this week. So that's why I'm saying that there's a bigger chance, I think, for the dollars to the dollar to find sellers on rallies than buyers on dips, perhaps on a weaker or mildly weaker number. But we still have to break the ranges. That's a fact. That is a fact. And unless we do so, we are going to continue to trade them.
Yeah, trade them. But as I've been saying, also don't get complacent about them, because when markets don't go sideways forever, and they don't stay in ranges forever. So when they go, they might go with a bit of a bump. Kate, do you want to have a quick look around to finish off the week? Show us your magic.
Yeah. Yes. Yeah. Okay.
You don't have to. we can call it a day and all go down the pub.
Yeah. Well, I'd rather, mate. Okay. Just a quick one. As we were already showing, the euro dollar stopped bang on the level here around 107.80, and then started to move higher again. Now we are back trading just around the top end of this little channel. I'd say that well, some say we could be doing something like this. So I move back up to 110 and then do the next leg lower. And some say that we've already done it. But in which case we are breaking back above the neckline. But I prefer not to trade too much of that right into this NFP number, and especially not after the move we've seen yesterday. So to me, there's a possibility that this goes back up into this zone anyway, because of how the market traded it. And I always like to trade several scenarios, or plan for several scenarios. That is a very good one, a good one, a mild miss, and a very bad miss. And I must say that 3 out of my 4 scenarios would push me to at least sell dollars on a rally today, which is quite different than what it was, what my scenarios were kind of telling me before. So it really has to beat all. It has to be an exceptional report, I think, for the dollar to lastingly rise against everything, and because we need for the dollar to go up, we need those yields to go back up. And I'm not sure. Even if we see a very good report and we see a spike up to 4%, I'm not even sure that this is going to hold. It all depends about the mood in the market. And the mood in the market right now looks to me like, if you look at this, the spike is there, and then you come off, and then the spike. The spikes look from the end of last week, and so the spikes start to look a bit more rapid than the moves down. Okay, so that is also a bit of a part of the PA, in my opinion, and I'd be looking anyway. If we see a rapid move down here, I've got a bit of an option put running in the euro dollar, but and until yesterday morning, I was short actually cash as well, and I'm lucky. I did buy everything back around in this zone here, sub 108. So I'm just running the option. But if I see any move down to 108 or just below 108 today, unless, as I say, exceptional, I'm going to be looking to start hedging it or even selling it out, because I'm only a half believer in the dollar right now, at least in the short term. Cable range, yes. And yes, of course, it's still the range, but we still have to say that any tests lower are quickly met by demand as well. Okay, so it's still going to be everything about the 126, call it roughly 126, give and take 5-10 points. 128, I'd argue, yeah, if it goes through, probably 85 figure. But if it's a weaker number, I'm going to think that this time we may not stop. If it's a mildly weaker number, we may not stop at the prior high, just because I'm that feeling about the dollar. If it's a weak one, also what now we know, the Bank of England is out of the way. I'd say this one is one of my currencies I'm going to at least pay close attention to. Dollar yen. Dollar yen. Look where we stopped, and that's the other side of the dollar, I think. And so, in case of a good report, where I would be a seller on rallies in other dollars, this one is probably going to do something different because of the risk. Okay, for this to crap out, for this dollar yen to go much lower, I think we need a bad report. All right, a bad report, because a decent report, which even may find rally sellers in other dollars, is probably going to support this better. Okay, so that's why I always say it's good to trade dollars, but choose your dollar wisely compared to what's coming out in risk-wise on numbers, right? On data. There's always two sides to a set of data. It's the currency directly impacted, and then the risk factor as well. And if we see what happened on risk overnight, especially in the equity markets, is not really a negative risk market. So in case of a good number, this one could retest the highs here, especially if we hold just around 146, in my opinion. And what supports this view is, one, the euro yen. We tried to get into the daily cloud yesterday, but we failed to get a close below, and the rebound is starting to look pretty sexy as well. Okay, we are about 100 DMA, but for me, I respect much more what the Japanese are looking at, and that is we did not get a close inside the cloud yet, where yesterday it was very offered. We rebounded quite sharply as well. If you want to look for levels to the top side, you're looking at a bit of resistance here, just into the 160s, into the 160, call it 85 figure. And then somewhere around here, 160.5 to 160.75. Okay, that's your resistance. But I would say that this is a pretty decent spike higher. It's going to have to be a bad one here to bring risk down. That's going to be the theme for the yen today. It needs to be a bad report for the yen to be bought again. Okay, even a mildly negative one, I would not start personally. I wouldn't start to buy yen and testifying all those. Yes, we broke down, but then you start to hold levels here on the FIPS as well. You do see a rebound. Same thing for all the crosses. Kiwi yen is actually a pretty interesting one because that since April of last year, it's starting to build this move higher. And yesterday we came very close to the trend line support, and we also bounced off it. Okay. So this is going to be a level to really keep in mind. Low 89s on the Kiwi yen. All right. If it starts to break low 89s, get a confirmation through 88.90, then probably we see bigger moves unfold in the Japanese yen globally. All right. Okay, we have to look at the S&P. So yesterday I was showing this in the room, this little trend line here. And I spoke about this 48.40. We went very close and we sharply bounced off it thanks to Meta, thanks to others, Amazon, even Apple and stuff, even though Apple missed sales in China, but that seems that the market didn't take that really as a surprise. Really what drove it even harder is the Meta announcing a dividend for the first time and at the same time announcing a $50 billion share buyback. So the market really jumped on the train. Also helped with lower yields and put us back to record levels. So I guess any mild miss here we need. And I always say the same thing. People sometimes think that it's the wrong correlation, but remember what happened in November. Okay, we had a very good labor report, and the same day the stock market rallied, and the dollar got hit, even with the yields not moving too much. Okay, so if we get a decent or even a mild miss, I think today the perhaps the 5K caps are going to be printed and come out. We really need a bad miss. A really bad miss is probably going to see a spike and then actually come down a bit. Okay, and then this is how I would trade it, a bit like the November numbers. If you get good data, decent data out of the US, this is not going to go necessarily down, even if those yields creep back up a little bit. Where I would put an alert right now is exactly 48.40. 48.40. If it starts to go down, then we're probably going to correct deeper. But looking at yesterday's move, is going to take some report in the States to bring that down under the 48.40, let alone 48 level. Okay. Last one, and then I really give it back to Ryan. Yeah, Euro Swiss, you're still short, right? For as long as it's below 93.40. That looks to be an okay position. Okay, so that looks to be okay. Just keep in mind support here, 78.6 at 93. The figure we are closing in there. We're also closing in on very important level on, in my opinion, on the dollar Swiss. High here, spike low there, went all the way back up to 86.5, and now we're already back at 85.5. Break here, confirm on a worse. This could really go pretty hard on the way down as well if risk is getting hit, because the Swiss, it should not strengthen in the mind of a lot of people. Swiss should not strengthen, and it is. So that's a bit of a danger trade here. If the number is really bad, get a confirmation through 85.30, then I think we are going to have a quick revisit here at 84s, and why not lower. I'm going to give it back to Ryan, but I really want to finish again by saying today I suspect we are going to find dollar rally sellers. But again, choose your dollar wisely, okay? Depending on how risk is trading. Back over to you, Ryan.
Thank you very much, mate. Good stuff as always. And good advice. Not all dollars are equal, as we like to say. Yeah, thank you all to you guys and girls as well for coming to the Flow Show and giving us your support here. Hopefully we're doing you well by what we offer here, analysis and advice and whatnot. Hope you're all learning from it, more importantly. Do let us know if we're not, and if you want to hear and read and listen to anything else that we've got for you, put it in the comments there. Not today, because I'm just about to shut. But for Monday. So trade well, trade safe over non-farm payrolls and the rest of the day. Have a great weekend. Be safe, be happy. Thank you, K-Man, and we'll see you all next week.
Cheers, mate. Have a good weekend, everybody.
Thanks,